Good afternoon and welcome to our second certification masterclass for June 2021. Thank you very much everyone for joining us for this lunchtime session to talk you through the certification program and unpack some of the really amazing work that myself and the team have been doing. Before we commence, I would like to acknowledge the traditional owners of the lands that I'm coming to you from, the Boonwurrung people of the Kulin Nation. I'm coming to you from my home in Glen Ira, and these are the traditional owners of the lands that I reside. But I would like to acknowledge all of the traditional owners of the lands that we're all coming to you from today. And we have people from Australia and New Zealand and even internationally attending. So in the spirit of this reconciliation, I would like to acknowledge the traditional owners of the lands that you are on and pay my respects to their elders, past, present, and emerging. Today, I'm joined by some really amazing speakers to talk you through our certification program and what's been going on. Of course, Ryan Cook and Tom Bunting, who work with me in the certification team. And if you haven't met Ryan and Tom before, I'm sure that you will in your journey of certification because they're absolutely amazing. And two other guest speakers that we've got today are Erica Miles, who's the director at West 9 Consulting, and also Jack McCartney from Sustainable Platform. Part of the reason why we wanted Erica and Jack to join us today is because Ryan's going to be talking through the due diligence that we do in our assessment of every single product that comes through certification. And the independent verification, of which Erica is one of our 5 panelists, and Jack is with Sustainable Platform, that's one of the 4 external ESG research providers that we use within our assessment framework and the due diligence of the program. So it's really important to understand that as a step within the whole program as well. So we're really grateful to Erica and Jack to be joining us today. So the agenda today is pretty jam-packed. So we're, as usual, we are going to get straight into it. Really important is at the first 5 to 10 minutes of every masterclass, we do a quick refresh of what the assessment criteria is for a product. So that's a really important part. Ryan's going to be talking you through that. We're also going to be talking about some of the things that have changed and some of the information that we've released since the standard was relaunched in July 2019. We're also going to be unpacking the 2 new guidance notes that we've just released. I'll be talking you through the product labelling, which has a real impact on greenwashing and other requirements of how you talk about your fund. And Tom is going to be talking you through our new 10 points on impact investing. So really, really topical issues there. Then Erica is going to talk you through the independent verification panel, what she sees on her side, what good looks like, and just some of the processes. And then Jack's going to give us a demonstration on the Sustainable Platform. And the reason why we've incorporated Sustainable Platform into our ESG research providers is their in-depth knowledge on SDGs and how they're incorporated into a lot of portfolios that we see coming through our certification portfolio. And then of course we'll have a question and answer. So let's go to the next slide if we could, Bryony. Firstly, let's cover the 5 categories of certification that RIA can help you with. The first one, which is primarily what we're going to be covering today, is for product. We also have investment management service, superannuation fund, whole of fund. We also have a certification program for financial advisors and financial advisory groups. I do know we've got a number of people attending this webinar that are constructing model portfolios, and we're looking at certifying those model portfolios, and that would come under our product category. All of this information is available in our certification toolkit, which is available via the Responsible Investment website. So let's go to the next slide. Why would you get RIA certified? What's in it for me? The main thing is that you can proudly wear the symbol of RIA certification. And it means that you have been assessed under the criteria that RIA has set. Now, this is a really important part to differentiate your product from your peers, because it means that your product has been assessed under that framework. But it's not only from your peers in mainstream investing, it's also from your peers who are within responsible investment, so that you can look at some of the assessment criteria and look at what is best practice in that space. It's also about growing funds under management. In our newsletter that we released yesterday, we've got some pretty amazing stats from ISS that looks at the fund growth and responsible investment for just the certified products, because we know there's a whole universe out there that do talk about being a responsible investment product that aren't necessarily certified. But our certified funds now make up 7% of the investable universe. And this is not changing. This growth is huge. It's also about getting onto the list. And we distribute our list of certified products every month to a wide range of audiences, to platforms, to researchers, to legislators, to financial advisors and other distribution networks. It's also about staying ahead of the game. And we talk a lot about what feeds into our standard, which then produces our assessment framework. And we're always looking at regulatory issues, international trends, and also what investor demands are. And if you're certified, we'll keep you up to date with what's going on, and then that will flow into what our certification standard is. So in terms of the next slide, that I'm going to hand over to Ryan Cook. He's going to talk you through very quickly the criteria that we use for every product that's being assessed.
Thanks, Cass, and welcome everyone. So as Cass pointed to, just aiming to go through the 8 key criteria we use to incorporate into our assessment certification. What I will point out at the start here is we do have, some guidance notes to support a number of these criteria. So we won't dive into the detail as such today, give you an overview, but there is a wealth of materials that supports these guidance criteria. So please get in touch after the session. We're happy to provide some more detailed information on those particular criteria. So to get started, we assess formally on your responsible investment strategies. Are they formal? So are they in policy? Are they embedded in the organisation's investment practices? Likewise, are they disclosed? Are they disclosed publicly on websites or other resources in the collateral? And then what we're looking at also is that information, is it consistent across those collateral resources, policies, PDS, IMs and the like. So if you have a responsible investment policy that says you have a certain exclusion at a certain threshold, is that reflected accurately and consistently across the documentation? That's what we look at and that's what we review. And then that is also part of the audit process, which Erica will present in more detail a bit later on in today's session. And then, is it fit for purpose? Does it match what you're saying? Is it just a negative screening process? Is it ESG integration or the like? So just trying to see if it's fit for purpose. But at the same time, we always say we're not prescriptive. We don't have a view that it has to be done a particular way. We're just reviewing what your particular method of investment is from a responsible investment standpoint, and that you're doing it in a consistent and methodical basis, systematically through your investment decision-making process. Secondly, we're looking at product labels. So this is probably one we get a lot of questions on. We touch on elements here we're probably familiar with around greenwashing and the likes, where there might be claims and labels that potentially are a little bit juxtaposed maybe from what the underlying holdings in that fund might be. Probably where we're seeing a lot of movements recently, and this is in relation to Europe and the SFDR. So a lot of the labelling and stuff that's coming out of that market, while it's not regulated here in Australia and New Zealand, is being used to inform how product labels might appear here in Australia and New Zealand. So it's an area we're watching very closely, but we just really look to understand, is a product label, is it true to label? Is it telling the investor or the stakeholder exactly what that product has in its portfolio? So that's what we're trying to look at there. We do have avoid significant harm criteria. Again, there's a guidance note to support this, and these are kind of minimum standards that we assess against. At the moment, the avoid significant harm criteria is centred on tobacco production and controversial weapons manufacture. We see those as really important social norms that need to be met to really verify that this is a responsible investment and can be certified under the standard. I will point out that we review these standards periodically, and we aim to take on board where the investment markets are moving and things like that. Obviously, things like fossil fuels and other themes enter those discussions. But at the moment, the minimum criteria we do have is for 0% revenue threshold for tobacco production and 0% revenue threshold for controversial weapons. Primarily in that equity space is where that impacts most. Okay, for the accounts for ESG, this is really, is it ESG, responsible investment, embedded in your investment practice, in your investment process? So again, is it intentionally part of the investment decision-making process, and is it systematically applied across that process? So that's whether you're looking at the underlying manager of a fund, are they incorporating ESG into their investment process as well, if it's a fund of fund. But likewise, when you're realising investments at any stage of that life cycle, incorporating ESG into that investment process is really critical, and that underpins what we're assessing against to make sure that it's applied systematically across that investment process. We have mandatory disclosures as well, and again, there's a guidance note to support this, but at the moment, the program's minimum criteria here for mandatory disclosures is around performance and holdings. So we have performance and holdings disclosures at minimum need to be done on a 6-monthly basis in June and December annually. We do have some provisions to allow for investments that might be in private equity and things. We appreciate that there might be some commercial and confidence material there, so we do have an allowance for 90 days over and above that 6-month time frame, just allowing for those sort of bits of flexibility and being practical, I guess, where we can. But we see those as really important minimum criteria, and quite often the funds that we're assessing, they already report these things on a more frequent basis than that 6-monthly time frame. And again, there's quite a lot of regulatory movements in this space as well, so we watch that closely. Active stewardship, I mean, all these criteria are really critical, and I could speak to a lot of them, but, active stewardship, again, is the one where we're seeing a lot of interest. To boil it down, we're looking to make sure that, the investor's walking the walk. If they're claiming there is stewardship practices applying to the fund, or maybe at an organisational level, are those practices enshrined in policy or the direction of what they take in policy, and then are they disclosed for investors? Because this can feed back into some of the mandatory disclosures part as well, but are those proxy outcomes and voting and engagement outcomes disclosed to investors in a transparent and methodical manner? There's all sorts of things going on here with investors and the likes of proxy voting and outcomes. There's a lot of government discussion around this particular field in Australia, but likewise overseas, a lot of things happening. But making sure, as I say, that walking the walk is really kind of the critical element we're looking at here, making sure that it's done consistently. Has the organisation got a commitment to responsible investment? So this is looking not just at the product, the fund or the service, but is there a commitment to responsible investment at an organisational level? So there could be UNPRI membership, RIA membership. Some of that does certainly help. But again, is there a responsible investment policy that informs investment decisions, informs some of the stewardship outcomes and things like that? Is it embedded into the organisation? And likewise, as staff brought along on that journey, is it part of what their training and development opportunities look like? Do they get involved in responsible investment in that sense? And does it have a wider profile than just maybe a niche part of the organisation, right up to maybe CIO, portfolio managers and like? So we see a wide spectrum of examples there, but we just want to make sure that, responsible investment has a place within the organisation. Lastly, we look at the education materials on responsible investment. We see a bit of a spectrum of examples that are provided here. Again, we're not looking to be prescriptive, but for an example of our education, we see quite a few members that have some useful information for investors on thematic interests such as renewable energy. We're seeing quite a lot on biodiversity and nature and things like that. So we're just trying to understand, are you providing some materials to support investors or stakeholders understand a bit more about responsible investment and providing that education? So that's a key element But we do allow, if there isn't anything during the assessment available that supports RI education, we do have an allowance to say within 12 months of being certified, providing some sort of material around RI education. Next slide, please, Bryony. Thank you. So as Cass touched upon, just going to be diving deep into kind of the due diligence process of certification. This diagram is probably best read in counterclockwise fashion. So I'll start at the top, which is the certification assessment, which is the slide I just spoke to. So myself, Cass and Tom, we receive the information through your online questionnaire, and we can give you an idea of timeframes and things a bit later on. But once you've submitted that information, we'll then go throughout about the process of the assessment itself against criteria that we just mentioned on the slide before. So we look at that assessment, we put it together. We also look at conducting any interviews. So that might be just some discussions with the people involved in the certification at your organisation, just to understand a bit more about what the information that you have provided as part of your assessment. We always make sure that we're actively engaging as part of this assessment and making sure that we have a full understanding of what the information you have provided is, and that it's supported by some materials. So we have a better, well-rounded understanding of the assessment and can make a more informed decision for certification. Underpinning a lot of that, and what Cass pointed to and is on the slide here, we're fortunate to have ESG research tools through ISS, MSCI, Sustainalytics and Sustainable Platform. So we use this in a lot of screening of portfolio holdings and things, just to substantiate that they might be clear matches between what you're saying is an exclusion to particular industry, alcohol, tobacco or the likes. We validate that information against these providers. We wholly acknowledge that different providers might have different information. So what we try and do is triangulate that information, understand, right, if one is saying there's a 5% allowance for tobacco, whereas the other might say 10%, we acknowledge that there's those variances in information. What we want to understand is basically try and get to a ground where we can understand what's underpinning your investment process using the information that those providers are helping us to provide you. So really quite rigorous. We're fortunate to have those partners, and again, Jack will provide a bit more of an overview of what Sustainable Platform provides as part of the assessment process as well. So moving to the bottom left, hopefully that's the same on your screens, the yellow panel. Once a month, we have the certification assessment panel, and the panel's made up of the RIA board and some independent members, including financial advisors and otherwise. We meet once monthly, and the certification assessment panel provides that governance structure to us. So once we've done our assessment, we then take it to the panel for a consensus on that assessment and whether certification is merited. So really critical. All the people in that panel have a wealth of experience across investment and financial services, and it's a really important part to have that really important governance structure in place and provide that overview for the assessment that Cass, Tom and I are undertaking to ensure that we're doing it in a consistent manner and applying some really realistic and measurable assessment frameworks and time, and also feeding into some of the timeframes we look at as well. So once the assessment panel is met once a month, hopefully, ideally, we'll work on a positive time mindset in this meeting. You've received your certification. We'll then be in touch shortly after to advise of the certification, any conditions that might apply. So we do find, there might be some conditions as part of that certification that might be needing to be met before we can formally certify the product service. We'll always talk to you about that. We're always transparent and always work within what is practical to achieve. So, again, it's a two-way dialogue as part of that process. Lastly, but certainly not least, is the independent verification panel. And this is a really, really important part of our process. Again, that important due diligence governance structure in place that we do have. We're fortunate to have the likes of EY, KPMG, West9 Consulting and Erica, who's presenting today, to really provide that independence of overviewing or undertaking an overview of the information that's been assessed as part of certification. I will point out, and I won't steal Erica's thunder here, that the independent verification is only undertaken when a fund is newly certified. It's not undertaken each time it's recertified every 2 years. The only instance that might occur is if there's been a significant material change to the product in that 2 years. But we often get the question of, do I need to go through the independent verification every 2 years? That's not the case unless there's a material change. So without further ado, I might introduce Erica Miles from West 9 Consulting, who's just going to give you a bit of an overview of what she does, some of the common instances she encounters, but I'll hand it over to Erica from here.
Thanks, Ryan. Just following on from Ryan's points, the independent verification comes in when the fund is newly certified. RIA also does 10% of its existing funds as spot checks, and also your fund needs to be verified if there is a substantial change to that fund. And one of the questions actually in the portal is a request for notifying RIA if there is a substantial change to your product. So just a little bit about the independent verifiers. There is a qualification process that you have to go through. You need to have experience in auditing and assurance. You need to have an understanding of financing industries, and you need to have an understanding of responsible investment and impact investing as well. You need to be professional, so you need to have membership of a reputable organisation. You're not allowed to accept bribes, damn. And you have to manage conflicts, and you need to be able to keep good records. But the most important ones are experience in responsible investment and also in auditing and assurance. So the verifiers that you should get will all have that experience and should be able to talk quite knowledgeably and have a really good understanding of what should be expected. So next slide, please. Just in terms of the typical, and I put in brackets typical because no one seems to be quite typical, process for independent verification. The first thing is the conflict of interest check that Ryan has to do for both parties. We cannot mark our own homework essentially, so we need to have a formal process of declaring that we won't be marking our own homework. We then do an initial portal review. We don't look at everything that's already done. We are looking at sections A, C, and D, and we do request updates to the portal that would be undertaken, and also any gaps in information. There's a full portal review is then undertaken once you have updated your response. And then there's also a follow-up interview, which does take 2 hours. Then we follow up with further requests. There is a requirement that we've got for 1 week for follow-up data. We did one a few years ago where the data took 3 months to come through, and RIA actually failed that audit. So please take note of the 1 week for follow-up requirements. And then the report goes to RIA. Just a point on the report is that it is based on previously agreed upon procedure, and the report belongs to RIA and it is the property of RIA. So if there are any issues, then RIA is the one that does talk to you about those findings. There are no recommendations for improvement given in those reports. It is purely a factual report. So it doesn't comprise an audit to look at how you could improve your processes. It does just literally checking that you're doing what you say you're doing. Next slide, please. Oh, there we go. Thank you. So just some tips for smooth verification process. We are finding a lot of new companies to the verification process. So I thought it's important to go through the sort of 5 top tips. The first one is be engaged. just you have done all the hard work. Be proud, and you may learn something. We do get a lot of really positive feedback that people haven't really do appreciate that third set of eyes looking at their process. So there's a lot of positives that can come out of this process. Maintain your portal responses, keep them up to date, provide all the requested links and attachments. One of the sort of mildly irritating things is that the links are no longer valid, and you can spend a lot of time trying to find the right links, which is time consuming. So it'd be really good if you maintained your portal up to date. Answer all the questions, including the process related ones. These are mostly in section D in the portal. And just going back to Ryan's point, really important that you do have a documented and repeatable, robust process. And there are some really hard ones in there too. The questions around audit and assurance, questions 55, 56 and 57, which are my favourite, they need to be answered as well. So if you haven't answered them, then we'll gently encourage you in that direction. Be consistent. The inclusions and the exclusions that you have in various documents and various claims, they need to match. And the revenue thresholds, for example, for exclusions, say on fossil fuels revenues, they also need to be provided, as do divestment timeframes would also need to be provided. So the interview is done after we've had a look at the full portal and had a look at all the supporting documentation. The trick here is to make sure you invite your team, and if you externally source your management to a separate fund manager, then they should come to the interview as well. The interview does cover quite a broad range of topics, so one person generally doesn't have all the answers, so please make sure you do invite all the relevant people. That could include your fund manager, your ESG specialists, and also your risk and compliance representative are all important people for that interview. And yes, it does take 2 hours. It's quite a thorough process, but we do have a reasonable chunk of content to get through. So next slide, please, Ryan. In terms of common findings, quite often get asked, so how did I do compared to other people? So thought it was really important to go through what we do find as problems, or not problems, but areas for improvement. The one is the purpose of the fund. Sometimes there's an inconsistency around what it is that the fund is trying to achieve. The claims are also misleading sometimes if they haven't already been picked up by the certification advisory panel. But if you are going to say you're sourcing more sustainable companies, then you need to define what more sustainable is and how you're going to measure that. Exclusions is a big one. The product disclosure statement, the fact sheet, the RI policy, and any other sort of SIPO documents all need to reference the exclusions. They need to make sure that you also mention the exclusion timeframes and also the revenue thresholds. Really important to make sure that those are all consistent. And then the other one I find is increasingly now is around commitments. So if you are making claims around say the compliance status of an issuer with the Paris alignment, with Paris agreement, that how do you actually validate that that claim is correct? And again, the other one is how do you, there's a lot of claims around SDGs. So our products align to the SDGs. That's like, oh no. So just in terms of the product side, really important to make sure that you are consistent, that you can back up your claims. And I do see RIA has just updated its guide for honest labelling, which is looking forward to hearing more about. And then the other side of the document sort of key finding is around the process. There are no, sometimes we find that there isn't a separate RI policy, so demonstrating your commitment. If you are marketing a fund that is, say, a European fund, you do need to have a process to manage the managers. There should be IMAs available, and you should be able to provide the RI relevant clauses of those IMAs to both RIA and also to your independent verifier. The exclusions, again, clear timeframes need to be specified. Measurement, again, if you are claiming impact, you need to have it defined and measured. You cannot claim that you are tilting towards a climate fund if you cannot demonstrate that you are actually making an improvement on a climate related metric. And the audit and assurance aspect is also one that we find consistently an area for improvement. An example there is, what is your process for auditing your external managers, for example? There's a lot of financial checks that are done daily and or quarterly, but sometimes that doesn't include exclusions, or if you are doing a positive tilt, it doesn't include verification that you're complying with any sort of positive inclusions as well. Although the financial checks are done, the RI related checks aren't often done. And then, of course, to go back to Ryan's point is the documented process. So the process for portfolio matching and rebalancing is a good one. Needs to be documented and just ensure there are checks for both inclusions and exclusions. So those are sort of the themes of the findings that we pick up. But I think through the having done more than a number of these, I think the positives that come out of it sort of outweigh the areas for improvement. I certainly do receive a lot of positives feedback from the companies that I do get to spend the pleasure of verifying. They do find that having the third party eyes looking over things can improve their performance, and also can point out things that they might not have been able to see themselves. So yeah, really good. And I think that's it, Ryan.
Yeah, thanks, Erica. And thank you again for spending the time to go through that. I'll probably hand it over to Cass, who I think is presenting the next slide.
Hang on, I'll take off mute. Thanks, Ryan. Thanks, Erica. I love it. You can't check your own homework. I'll have to use that again, because the certification program is very much that you can't check your own homework. This is an evidence-based program that if you're saying that you're doing something, then we would have to actually see evidence that you are doing it. And it's great to hear Erica's view, because it's really how everything comes together. But first of all, before I talk a little bit about product labeling, I want to talk about the 2 years in review. If I look a little bit older from the last masterclass, it's because I think we've jammed in 3 years of work in 3 months. But some of the things that we have done over the last 2 years is released a lot of guidance notes. Now, this is not a deviation from the standard. The standard, as Ryan spoke about earlier in the masterclass, for a product covers 8 key categories. But each of those categories, if you're applying that to a fund-to-fund, a hedge fund, to an equities base, to a property, there are nuances. And what we found was, as an assessment team, we came up against these questions. And it was really important for us to share that with our members. So these are some of the guidance notes that we've put out to our members. These are all available in our certification toolkit. But I think Ryan mentioned before about avoiding significant harm. The minimum requirements here are tobacco and controversial weapons. What does that mean? What does that mean for a fund to fund? Multi-asset products, what is the minimum fund coverage that you have across your assets so that you've got a sufficient responsible investment strategy across your tactical asset allocation? We looked at stewardship practices. As you probably are aware, we tightened up the disclosure requirements as at the 1st of January 2021. Now, we announced these changes with the launch of the standard in July 2019. So nothing actually changed, but what we made it was mandatory as at the 1st of January 2021 to disclose. Now, this covers engagement and voting, and there's not one way to do this. Engagement and voting is a key responsible investment strategy, but we're not prescriptive in what you must do. What we've said here is that from an investor's point of view, this is what they want to know. They actually want to see that your voting is being done. Now that's either providing a list of what your voting is, or in terms of engagement, it could be a list, or it could simply be, this is a summary of where we've been successful over the past 12 months. Knowing that there's some intellectual property and engagement is a long game. So we're not wanting you to give away your secrets, but we want to see evidence that it's happening. Again, the program is an evidence-based assessment program. Portfolio holdings disclosure. We were having some tricky issues around venture capital and private equity in multi-asset funds and super funds, because this is starting to be something that is an asset that we see in most super funds. But there are privacy issues around disclosing what's in your VC and what's in your PE. So we made it so that it can be disclosed to RIA, so we can check it, but not publicly disclosed. And so we've made allowances there. We've also made allowances for ETFs and LICs because it's more transactional. It's about providing information on a regular basis. We're not here to hinder the process. We're here to help the process. Impact investing, huge space. Tom's going to be unpacking that. He's been doing a lot of work on it. We did revise it, and this is the new revised version where it's a little bit clearer as to what we want, and it's going to cover equities, it's going to cover all investment style products. Product labeling, which I'm going to be talking about next. Coming up, you would have received an invitation yesterday about our new ratings. So this will form part of the certification program. It will be rolled out by our certification team. It is using the same assessment criteria that we use in the certification assessment. But I don't want to talk too much about that because Nicolette's been doing all of the work on that. I don't want to steal her thunder, but I'd really encourage you to come to the briefing session next week. We're also looking at a new certification symbol. I just want to preface that here. We will allow you sufficient time. We will provide ample information about what this looks like, knowing that PDSs only roll every couple of years. So we understand the implications. But what we wanted to do was give our symbol a refresh so that it is really clear to your investors when you have gone through all of this hard work, you have gone through this assessment, you have gone through this due diligence in terms of the IVP, you've gone through the cap assessment, and we want to make sure that that's really clear to investors, that you can set your product apart from your peers. So that's the 2 years in review. So let's talk a little bit now about product labeling guidance note. This is kind of the intersection of where all of the assessment criteria comes together. Ryan spoke about the 8 key criteria. And when you read the product label guidance note, we will talk about P2. P2 is product, the second assessment criteria within the standard. And it says, make honest claims and are appropriately labeled. It was interesting. I did go to a presentation a couple of weeks ago where there were a few marketing people, and their words, we're going to go hard on this, how we label this product. And I said, I would urge you caution in that, because one of the key components of our program is that the product reflects what the investor is getting. And this is affirmed by the FMA in New Zealand and the ACCC in Australia around our greenwashing claims. So the product must be delivering what it says it's doing. And the best way to describe this is to give you some examples. And in our product label and guidance note, we do give you some examples. It's important, we're not prescriptive. But if you say that you're a low carbon fund, we actually want to see that you're trying to be a low carbon fund. Or as Erica was talking about SDGs, that you're aligned with SDGs. We want to know that, as an example, you're using sustainable platform to ensure that your portfolio is aligned with those SDGs. And a couple of other things that come into that is the second bullet point there is that you disclose this information. So if you're a low carbon fund, we want to know, well, what's your measure? Is your methodology disclosed? And again, that comes under requirement or assessment criteria 5, which is around disclosing the information. We want to know, have you met that target? So again, if you're managing your portfolio constituents to be 20% less than the carbon emissions to be 20% less than your benchmark, we actually want to see, well, have you met that target? If you don't meet that target, that's okay, but you need to disclose that you haven't met that target and make it clear that what your process is going forward to ensure that you do meet it. So this is really the intersection of all of the other assessment criteria. So we will look at, what do your documents talk about? We will look at, what is your stewardship practices? Is it feeding into your product labeling? What are you disclosing? Do you have the methodology? Now, I've put up some words there. These are, most of our funds fit within these type of parameters, but it doesn't mean you have to call them that. That's really important. We're not taking away your creative license here, but what we want to make sure is that how you label the fund is what the investors should believe that they're investing in. And if we could go to the next slide, which I think is somebody else. Yes, it is. Okay, so I'm going to hand over to Tom. This is another guidance note that we've been working on.
Cool, thanks, Cass. Yeah, I guess this piggybacks perfectly off what you were saying now, and that we need to make sure that RIA is clearly defining what we expect of different labels, and when we go and verify the underlying investment process, that these products are indeed delivering what they claim to be doing. And I think impact and impact investing has massively been the most popular buzzword that we've seen being tossed around in responsible investing. Certainly over the time I've been here at RIA, we're getting it from all different angles in certified products, be it from venture capital, private equity, credit portfolios, and more recently public equities. And so what we've done to respond to this surge in impact investing products is actually develop some guidelines in the guidance note that gives some structure as to what a reasonable consumer can expect from impact investing products. And you'll see there very quickly that we're drawing on the 3 pillars of impact as we've seen it with other global bodies, such as the IMP, which is the Impact Management Project, the Global Impact Investing Network, and the International Finance Corporation, to make sure that we're aligning with conventional definitions of impact so that we don't harm their or our credibility if we differ from them, but also that we're all moving in the same direction. And so that when we grow and refine our understanding of what is the most impactful way to manage your portfolio, we can directly incorporate it into our guidance notes. And so, as I mentioned before, this impact investment guidance note is actually applicable to all asset classes. And I know it's impact in public equities has been a hot topic, and that's certainly something we've accommodated in our assessment framework for impact investing products. So what underpins our ideas of intentionality, additionality, and measurement? And if you've looked at the guidance note already, it's actually 10 different impact tests that maps quite well to each of these pillars. So for intentionality, the first 3 tests will be about your theory of change. Conventionally, what is the gap that you've identified between the world that we want today and the world that we see tomorrow, or that we want to see tomorrow, and the mechanisms you're employing to bring about the change that closes out that gap. In the context of impact investing, it's about identifying the environmental or social issues that you want to address through an investment portfolio. And so that's test 1, where you also need to be realistic about the impact that's possible through the asset class of your product. And so the second test is around how you're selecting investment opportunities to address those environmental or social issues, which will actually form the basis of how you measure your progress on your impact goals, which is indeed the second pillar of impact investing. And so the third test will also come back to how are you defining the rationale or stating how each company in your portfolio, and yes, we do look at in the process every single stock in the portfolio, whether it's 50, 10, or 100 stocks. We want to understand why have you chosen that particular security for inclusion in your portfolio, and how is it aligned with your impact thesis? And so those are the three tests that really encapsulate the theory of change. The fourth test, very, very straightforward, is how does impact relate to your investment process, and more importantly, risk and return. At a minimum, we would expect impact investing products to have impact as at least equal with risk and return, if not being the primary driver of the investment decision-making process. And then finally, the fifth test around intentionality is, have you thought about responsible exits? Is your portfolio creating a cradle for investments that may be coming out of private equity to actually sustain the impact that company has, and make sure that as an investor, you're not actually causing mission drift to that investment by asking that company to perhaps sacrifice R&D that would essentially hinder its ability to deliver on its impact. And so it also works the other way around, where if you're a private equity or venture capital manager, you need to be considering how your investment, the way you exit your fund actually has an impact on has an effect on the sustained impact of your holding. So that's responsible exits, and that's the fifth test under intentionality. Then we've got two tests for measurement, and that's really about, one, how are you measuring the impact of your individual companies in your portfolio, and subsequently, how are you aligning that with the impact goals that you stated as part of your intentionality, and reporting that to external stakeholders, and at the very minimum, your investors, at least on an annual basis. And so these is another pillar of impact investing that needs to be really well covered in order to be certified by RIA. The last one, and possibly the most tricky part of impact investing, is additionality, otherwise known as investor contribution. And so the easiest way to think about this is, what are the different ways that you as an investment manager are lighting a fire under your portfolio companies that helps them further their impact through their core business products and services? Essentially, how are you helping that company improve the quality of its outputs or its scale of outputs in order to address the real world problems that you've identified, be they environmental or social? And so conventionally in private equity, additionality was very simply thought of as, well, this company would not be able to fund its operations but for my investment, and so you're being highly additional. And we realized that while that's a very simple and direct way of eliciting investor impact, it's not actually the only way. And if we are to address the scale of problems that we see in the world today, then impact must go into public equities to help companies transform companies and help them actually grow their impact in a way that makes a real difference. And so other ways that we look at additionality, and the IFC, I should actually mention, calls for a narrative of how your product is being additional, is, are you forming partnerships with your products, with your individual portfolio companies, and knowledge sharing, giving them strategic advice, or meeting with senior management to improve impact outcomes, as well as how are you actually directing capital to grow undersupplied capital markets such that your investment actually changes the cost, amount, or terms of capital available to companies, or elicits a change in price that incentivizes them to deliver greater impact. And of course, in addition to injecting direct capital into your companies, be it a secondary capital raising or a Series A, B, C funding round. Again, impact, as we've defined it, is not necessary. There's not one way to do it. We've just set up a guidance note and a framework for you to demonstrate how you're adhering to each of intentionality, measurement, and additionality. And a part of the process will be that each investment manager that wants to certify an impact label product will need to be very clear on how they adhere to each of the impact tests. And if you don't necessarily hit the mark on one of the tests, you need to at least explain why that is the case. And then what we're going to do is actually present that impact product along with the impact test results to the certification assessment panel, who will then assess whether the product can be certified, especially using the quality and thresholds test. More importantly, the thresholds around, is this what a reasonable consumer would expect from an impact product? And secondly, would this impact product befuddle or belittle the impact investing name. So that's really it for the impact investing guidance note. It'll go into a lot more detail when you access it on the on our website, RIA website, which I'll flick actually to the next slide. All of these guidance notes are available on the RIA website under the resources page, and you can get them under the certification toolkit. And it is the first tab that you'll see there under standards and guidance notes. So happy to answer questions as well, but for further details, definitely go check them out. And that's not just for impact, that's also for product labeling, as well as the avoiding significant harm guidance note. So that's me for today. I'm going to pass on to Jack McCartney from Sustainable Platform, who we are very lucky to partner with. They're a very new player in this space, but they're already making huge strides in helping investment managers map their portfolios to the sustainable development goals and help us achieve better real world outcomes. Thanks, Jack. Over to you.
Thanks, Tom. Well, thank you. Let's hop into it. So, who is Sustainable Platform? Well, we are the world's leading independent SDG and ESG data provider. We're a team of Australian-based data scientists and sustainability PhD specialists. And the business was set up in 2014. And we have developed the world's largest database of companies measured for their contribution to sustainable development. Next slide, please. So what we do is provide sustainability measurement and monitoring of SDG data, and that's in accordance with the UN's principles and taxonomy. It's a range of data that we produce, but some of the more important ones are around the sustainability risks, such as greenwashing, carbon, stranded assets, reputation, regulatory and transition risks. We enable fund managers, and it could be managed funds, providers, these sorts of things, to construct their own portfolios, and they can do that through the range of companies and products that we have. And you're also able to compare those portfolios you've designed to your relevant benchmarks as well. The other thing you can do is you can provide client reporting on that particular data, and which that can go back to relevant stakeholders as well. So that could be your risk committee, for example, your directors, could be to APRA and ASIC as well. So why we're different is we're 100% Australian owned, and we actually provide our own proprietary SDG data. We source all the data ourselves. It's our own data. We don't use underlying providers. We focus on companies' positive SDG contributions via their products and services. And our data has been independently proven to add alpha and lower risk versus other ESG data providers. So we always knew that was the case through our own testing, but more recently through a group called TGM, they've also proven that. We believe what we do is to provide meaningful metrics that set the standard for what sustainable investment means. And our data has actually been shown to the UN as when they were developing the SDGs, and they've described our data as a great resource. It's also nice to have that support from the UN as well. Next slide, please. How we add value is that we have an easy-to-use artificial intelligence cloud-based platform, and this enables you to analyse any company on the platform, and you can also get relevant downloads for that particular company as well. The universe is large. It's over 18,000 company listings. That's global, and it's greater than the 97% global market cap. And we also have over 1,400 products and services that you can sort and design portfolios on as well. We have PhD and master's level support in the business, there for design and developing the product, but also there for answering your questions on sustainability and metrics questions that the system produces. We also, in the interest of transparency, which we know RIA loves, provide our own SDG methodology, taxonomy, and also marketing charts. So you said all clients can see under the hood what works, what makes it work, and all the supporting documents as well. We've actually find the marketing charts are very popular. We're finding probably about 1 in 2 clients are using those. So seems to be a bit of a point of differentiation as well. The other thing we also have is, it's like, I guess you could describe it as a chat system. It's an investment community on the system. So how that works is that you might be looking at something a bit topical, bit good like Rio Tinto and Duke and Gorge, and you could be posting some questions about that particular situation and what that means and implications and the underlying data. We will come back and in turn give you answers on that particular situation, but other fund managers or analysts could actually also come back and provide their input on that particular situation as well. You can post questions and answer questions confidentially if you wish to as well. It's also a process of keeping us on our toes too. So if something happens pretty quickly in the market, we know about it, and sometimes we'll argue the toss and say, look, we think you've got a view there, or otherwise we might say, look, our principles and process support this, so we're going to stick with our view. Thank you. Next slide. Yeah, thank you. This is a bit of data here, a bit hard to read, I know, but this is an example of a benchmarking output report. This was done for the Norwegian Sovereign Wealth Fund, which they're about US 1 trillion at the time. They used Sustainable Platform to analyse their portfolio and found that they had a much larger carbon footprint than they thought was the case. And through using Sustainable Platform, they were able to move on about 100 million US out of their portfolio. So they were, quite a significant change through using our data. I'm sure you can actually see some of the metrics down the left-hand side there. We would probably argue that we have less metrics versus other providers, but we would argue they're also more meaningful. And you can probably see that there's a carbon risk metric which went down. Their portfolio reputation risk also reduced, which is good. Their controversial industry exposure reduced. Again, that's what you want to see. Environmental exposure risk reduced, excellent. And also their SDG contribution footprint went up. Well, also that's the right trend. We want to do that as well. And their greenwashing risk also reduced. Again, it's gone in the right direction. So next slide, please. I mentioned before about our data being tested externally, and a number of you would probably be aware of Tactical Global Management. They're a 25 bill, they're a global quant manager. They used by a lot of super funds and fund managers generally. TGM more recently analysed our data to a range of other ESG providers, and pleasingly they found that Sustainable Platforms data added alpha and lowered risk using TGM's overlays as well. So a combination of our data and their processes. And you can see on the left there, the outperformance was quite significant. They did it over about a 15, 16 year time frame. And I think that's compared to the MSCI All World Index there. So quite a lot of our performance, significant actually. And you can also see on the right-hand side, the information ratio was quite solid as well. So again, that's TGM's data. TGM has since signed up as a client. They're actually using our data to develop a global SDG portfolio as we speak. So they're very happy with the data. Next slide, please. This is just showing you the Sharpe ratio calculation that was also done by TGM, and as you probably all know, the higher the Sharpe ratio, generally the higher the risk-adjusted return as well. So again, very compelling data. Next slide, please. we have a number of groups using our data for research. A number of you probably would know that Lonsec uses our data for they call it the 5 Bs, as in the buzzing bees, and they also use our data for, I guess, presentation. As you can see, the SDG chart is a sustainable platform. They're using it, I think, also for fund-of-fund calculations as well. Obviously, RIA is now using the data, and there's a group, Ethical Advisors. They've been using the data for quite a while. They're using it for their fund of funds as well. And there's also Elm Asset Management down there. They've got a leaf system. They've got a 5 leaf system. 5 seems to be the popular number these days. And they're also rating fund managers and super funds as well as part of their process. Next slide, please. I mentioned before the marketing collateral. We have a range of data or reports that you can produce, and obviously there's the chart on the left there, which is Ethical Advisors. They've done that circular pie chart, just showing the SDG footprint for their fund. And you can also see there's that little box there, which just shows you, again, that's pretty hard to read. I can't read it, but I can tell you that the first line shows you it's got 55% less carbon risk in the portfolio, 62% less reputational risk, 83% less greenwashing risk, and 63% higher SDG footprint. So that's a pretty good summary of the goodness of that portfolio and the difference it's making from an SDG point of view. And you could, I think most people would agree, that's a pretty powerful summary that you could tell an investor, and they get it pretty quickly, that this is a pretty powerful portfolio in terms of the goodness it's providing. The other charts there are a couple of examples that Elm's using, and it's showing you there that their portfolio has a much lower carbon risk. It's got no greenwashing risk, a very low reputational risk, and a very low controversial industry exposure. And the chart on the right there of the screen is just showing that it's got a higher SDG contribution. Again, fairly compelling charts in a visual sense that and this is this is our sort of sorry, next chart, moving through it. So we've got a range of clients, and we've actually in the last few months actually signed up a lot more as well, including a large super fund and some other highly regarded fund managers and some global fund managers we're speaking with as well. More so, I think if you could see the range here of the range of our clients. So as you've seen before, we've used groups such as, sovereign wealth funds have used our data, but we also mentioned we've got ethical advisors, they're financial advisors, and that obviously aligns with what RIA is doing. The service can be used right from an everyday advisor who could be, in Launceston, Tasmania, and they are, because I've spoken to them, and right up to large super funds who are using the data for analytical purposes and designing super funds. We've got hedge funds, we've got fund of funds, family offices as well. And you can actually, if we don't have a particular investment there, I think you mentioned before, might have been Ryan, about private equity, we can actually load those up because we've got a process of getting that data and including it for clients as well. So you can get the whole footprint from an SDG point of view for your portfolio. And just to finish off, trying to be prompt today, I know you're short on time. Look, that's my details there. I'm on the East Coast if you'd like to find out more information. The other thing that we can do is we find is most clients, prospects enjoy a trial, so we can provide a 3-month trial on the service, which is, I think, is the best way to really understand the power of this system. And that's it. I think I was stuck right on 10 minutes there, Ryan. Thank you.
Excellent. Thanks, Jack, so much for that. It's important that we show our members what we're actually using in our assessment process, and using sustainable platform, as I said, they're one of our 4 ESG research providers. So we incorporate that into our assessment process to check on the validity of some of the claims. Sorry, we've gone a little bit over. There's always so much to talk about in our masterclass. Our pre-cert checklist, if you are thinking about certification, is a really good way to start. I think it takes 2 minutes, but it will come directly to the team, and then we can be in contact with you. But feel free, if you would like to talk to either Ryan, Tom, or myself, just reach out, certification@responsibleinvestment.org. One thing I just did want to mention again was our ratings initiative, and the briefing will be next Monday, which is on the next slide. And I would really encourage you to come along to that. We will answer a lot of your questions. We'll take on board some of your questions, and increase the briefings from here on. The next certification masterclass is in September. There are about 3 other topics that we were going to put forward for today, and we just didn't have time. So, one was in terms of the regulatory environment. If you had ideas that you wanted us to cover, by all means, email them through to us. Thank you again, everyone, for joining us. And if you've got any questions, because we didn't get to the Q&A session, if you could email them through to us at certification@responsibleinvestment.org, and we'll come back to you personally, or pick up the phone, go old school. I'm Cassandra Williams, and thank you very much for joining us today.